Okay, Monday, October 24, 2016. What I'd like to do is run through uh, the Dow Jones 30. These are weekly bars. What I'd like to show, though, is what I'm seeing when I talk about the internals. The underlying issues are being rotated and clubbed. This morning, on the open, we saw the reaction of the Time Warner AT&T merger, and I expected that the market would open up at the high and be a little cautious about the herd being stuck at the highs of the day. As of right now, they have rolled over. The index futures have rolled over since the open. The NASDAQ is the strongest of the bunch and has been for a while. Like I mentioned before, if I put my floor trader jacket back on and badge, selling the open would be an obvious choice. It doesn't change the underlying structure of the market. The chart with the pink dots on there, the summation index, that underneath the market, a lot of issues aren't contributing to the upside. And a lot of them, I keep pointing out, IBM peaked in 2013. Both the New York Stock Exchange and the Russell peaked in 2015. So I'm not looking for a sustained bear market, but what I'm looking for is some sort of hard correction. And it could be as quick as we saw with China, where we lost 300 S&P handles, dropped down to 1,800. So that's what I'm looking for. Like I said, I'd give it through the end of November. As of right now, as long as the S&P can hold, I've moved it from 2140 to 2133 because that's where the POC, the point of control, is on the charts that I mailed out to subscribers this morning. So let's just run through this real quick here with the Boeing. I found very few stocks, Boeing to be one of them. I think Exxon another, for places that are possibility that if you're going to hide out in something, collect dividends and possibly get some capital gains. But like I said, you have to be cautious because since basically August, this rotation underneath, the rolling correction, if the market continues higher, has been going on. So hopefully here, after going through these 30 stocks, you'll understand where I'm coming from. So here's Boeing it's getting a swing here, but what you have here is a series of higher or lower highs. And this chart goes back to November 14 on here. So we're talking, here we have another one. Boeing peaked in 2015. Here's 2016 on the pullback at the beginning of the year. Basically, I'm going to have to treat this as a bear market bounce with a lot of sideways here. It's like I said, I'm not looking at a correction from post Brexit. I'm looking for something a little bit from basically the 2011 low up. We also have debt dropping again today, so interest rates are moving up, and this is on the back end today. So you have one of these things where you're getting the market to go up, but you're also getting interest rates to rise. At some point, this is all going to catch up, depending upon today's close. I'd mentioned that I thought that to stay long into Tuesday, because we have earnings from some big names out there, to see if the bulls can hold this, because this is basically the bulls' game to lose. I sent out that chart with the money flow of the daily ES Sunday night, and you could see all that space there. And that's the amount of money that's out of the market that's willing to probably to come back in if the bulls can pull this out. So it's a bulls' game to lose. If you're playing individual issues, as we go through them here, you can see that they're already being clubbed. So here's Boeing. Here's 3M, basically the same thing. This one just peaked recently here. Remember that the stronger dollar will cause some of these conglomerates to have repatriation problems with their currencies. So, and what they end up having to do to compensate is they have to end up dropping their prices to get the sales. Boeing's a little bit different because it's basically a monopoly here. for airplanes. Here's 3M. Basically, you have your double top. It's pulled down. I believe the moving average here is this is a 40, so this would be like a 40-week moving average. And when I started out, we were all doing 40s, 40-day, 40-week. I've seen that we switched over to 50. What you can do, hint, 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 is put on a 40 and a 50. And then you can, let me see if I can add that on real quick here. Weighted moving average I like to use because it used the most recent data. Okay, so here's the 40 and the 50. Not as much as on the weekly, more on the daily would show up here. Let's see if sneak it back to a daily. Okay, all right. This would be an area here that you come into short. Here you have the dotted lines here, dashed lines are Fibonacci levels. Okay, so here you have an area with moving averages and a Fibonacci area. So if you are short, this would be an area that you'd want to short. Add to your shorts. Okay. In theory, though, it's every time you make, here's a low. When it comes back through, this would be a short. You'd move your stop. If it comes back through here again, you'd move your stops from up above to here and continue to short on every new low. Basically, you're adding to a winning hand, which is a tough one, right? A lot of us can hold losses for weeks and hold winners for hours. All right. 3M. Okay, here's Microsoft. Microsoft has basically taken over the role of Apple. Like I said, I'm over at the college taking math courses and that programming, blah, blah, blah. And this year they installed Microsoft for a cloud-based network. So that's where Microsoft is making their inroads, not as much as, leasing or renting their office for $10 a month. But they also have the cloud net, we rotate through a lot of software at the college, different forms. Some of the nicer stuff like Math Lab and that they got rid of. So, but we're at a full roar in the economy, so college enrollments should be dropping. Microsoft, let me see here. Once again, Microsoft was dead money for a long time. This goes back to 2007 because of it peaked in 2000 and it didn't. It took 15, 16 years for it to eclipse the previous high. So to me, it was a tradable stock, but I'd prefer to look elsewhere. Okay, here's Visa. Visa, we're getting, whoops, need to drop that down. Okay, so Visa here. Okay, so we have our Fibonacci levels here. It's beginning to wane on the momentum on here, and you can see that the unbalanced volume got pretty frothy on the recent high. Anything below, what is this, 80, 81, it looked to be on the short side of this here, and it could drop all the way back down to 74. So set an alarm at roughly a little under 81, 80 per se, what have you. Let's take a look here. Here's 81.50. That would be a wonderful. Okay. All right. Yeah, what do we have here? Okay, so we have a high. So basically we have the action of a series of tops here. This is a spinning. This is probably going to be a decent reversal on Visa here, this type of pattern here, where it shoots up, opens at the high, and it's currently trading at the low. Okay, so we're going to probably get a reversal in Visa here. Okay, Nike. All right, Nike. I went after Nike, which of course peaked last year. All right, so we have Nike here. We've come down. I mentioned a lot of these here. If the bulls get back into the, if the bulls can pull this out here, right now we're doing the wallowing thing again. We're basically stuck in the long range, multi-month range here. That if the bulls do come in, I'd be looking for some of these that have been beat up to get in there. So basically it's one of these things. I'm not a big fan of buying options. To me, it's like taking $100 bill, going into high stakes, putting it in the machine, and pulling the handle once. But this for Nike, I would be interested in somewhat of a, say, if there was a couple of down days here, and I thought the market was going to go higher. Okay, then I would probably buy some calls. I want to pay as little as possible for the calls and short dated, and I don't pile a lot of money in there. It's one of these things that say I buy them at a nickel or $5, I buy 20 of them, that kind of thing, and then go from there. And the problem with options when you're buying this cheap, say it costs you $1 or $1.50 in and out. Well, that's $2-3. So if you buy it at a nickel or a dime, you're talking, 60% of your cost now is commission, or a third at 10 cents. So that's the downside of buying options here. But I would be interested in somewhat of taking possibly going long on here if the bulls can pull something out here. I'd say by Tuesday. I'm going to give them a couple of days here because of the buyout usually gets people all jumpy, and that's where the market stays irrational longer than you can stay solvent. Because, like I said, we saw the underlying. A lot of stocks have come off, like this one here. Nike's not participating. UTX, this one peaked back in 2015. See, here's 15, basically going sideways to down. Cisco Systems, that one was a lagger too. Remember that Cisco was the number one at the peak in 2000. Cisco was it, right? Cisco was the number one, cap weighted company, and it died, and it'll probably never go back in my eyes. This basically looks like a topping pattern here for now. I'd probably call it an intermediate, just due to the fact that they rotate like they rotated, say, out of IBM and went into, out of Microsoft, out of Apple into Microsoft. So it's the same thing here, that when money comes out, it has to go into something. So in this case here, it's basically technology. That's the swing that we're in. We're in the last half of the real estate cycle. And also we should have investment out there, and that'll be technology. But this is somewhat of a, you have a bear flag here, and continuing the same thing here. We're talking, we're flipping dimes here. So to me, I'd pass on Cisco. Basically, I just want to point out, like IBM, of the issues that they're just not contributing here. Home Depot, talked about that before too. Possibly, we'll just say that this is a head and shoulders. You can see it roll over. It's under the moving averages. Remember that these homes that are going to be built are going to be new homes, so that the lumber actually comes from more wholesalers, like your lumber yards, not as much as your Home Depots and that. Here in town, I notice I drive by a lumber yard. We have both Lowe's and Home Depot and some lumber yards and stuff, and you can just tell they're basically go hand to mouth. Basically, I went in and asked the guy about hedging on lumber, and he just says whatever comes in, I put in my add my profit, and that's it. So they move a lot, because I went out and counted 1 bundle, 2 bundle, 3 bundle, 4 bundle, and counted one. Well, you could use my services, but it's one of those things that they're outside of speculating, the markets do serve a purpose. So, but this one here for right now, it does look like a topping pattern here. And also remember that Home Depot, we're talking, these are all the foreclosure homes that have been added, new things to them to spruce them up. We're getting a lot of sprucing here, basically inside interiors and outside. I've seen some of these homes where I live. I've been here 15 years now, and some of these homes have had a few different facelifts. And we're doing the desert brown stucco thing again with the wooden posts in the front yard. Actually, the one thing I'd like to get into is that what is it, like sheet metal, scrap metal? statues, because of the desert's just so nasty on where I'm at. We're one step above or one step below Death Valley. You know, I had to leave Minnesota and flip the thermometer around and go from -40 to +40 Celsius. Yeah, right. All right. So same thing again here too on Home Depot. I recently went there and purchased some stuff, but I had a leaky pipe, so I was kind of quiet in there during the week. So this with the tails above here, I just think this is going to roll over. Use the moving averages as a stop per se for short. Travelers insurance companies. I posted this on stock twits about shorting up in here. Same thing, you know, multiple tops couldn't do it. Came down to the moving average, rolled over in a hard sell-off here. Insurance companies should be doing okay as interest rates rise, but in the meantime, they're falling victim to everything else out there. Coca-Cola, usually a place to hide out. You know, we're talking, you know, if it goes from 42 to 44, if that's your thing, Warren Buffett, if you're listening, I look at it as, you know, we're now drinking everything else but soda pop. So, you know, Coca-Cola is nice. I grew up with quart bottles and stuff, but it's, you know, if we're all drinking water, you know, I can tell you that what Coca-Cola puts out and isn't what I drink, you know, when it comes to water. I prefer the spring stuff or the bubbly, which started this all off. All right. Effervescent mineral water. Coca-Cola, it's, you know, you can't rule out different type of mergers here. Usually that's what we get at the end game is we get a lot more mergers because they have to do something and they basically cut costs. And because there's a lot of redundancy out there, and that's what they do. They merge. So what we just saw, you know, was that $85 billion merger. But even that merger with the Time Warner and AT&T, it comes down to content. And like I talked about video on Sunday, you know, ABC was hot in the 70s, and you had NBC in the 80s. Now we have CBS. So it all rotates. So, you know, you may have it for a decade, but then you have 2 decades to suffer. And if for some of you who are older, I think Sony bought Columbia. I think Coca-Cola bought Paramount or something. And then it spun it off. But there was a lot of that going on in the early 80s too. We were still going to the movies then, and guess what happened? Cable TV showed up, and the movies theaters just collapsed. Mine now is a medical office, the one that I used to go to. Okay, here's Apple. Okay, so here we have Apple at a Fibonacci number. We have earnings coming out. We have moved off the bottom. The tops for the shorts were an easy peg because the kids just would not, you know, they kept buying calls. You know, you kept seeing 145, and, you know, and as we saw with this, I think this move here, we saw people buying calls up to 190. So, I mean, you know, here they're more frothy than they were up here with their, you know, what they were buying. And we're only this far. Money flow is not in there. Where's money flow? Money flow is, you know, faltering. Unbalanced volume is less than at the peak. So there are fewer participants in here. Here's the peak in 2015. This is a pretty decent sell-off here. This is what, 25%? We're getting a bounce. I look at it as, you know, if Apple will say loses 112 again, it's going to slide further. And that's what it is. Like we just mentioned on Cisco, if you're the number one company, you know, Exxon was the number one company, cap weighted. They maybe string a couple years together, and then that's the end of that. So a new company will, when you're number one, you can only go down. So in my case, what I mentioned is I mentioned here's about 121 or so to 125. If we do get some sort of rally of earnings, the whole, what was it? What was it? One company fell a third. Netflix went up 25%. That's very painful to anybody. If you get to the point that you buy both calls and puts, if you're that type of person, and then hope you snag one of those. So, but if there is anything, it's to me just by looking at the peak and where there are with their product. There's a product in marketing. There's a product lifespan. All of a sudden everybody has it. So who's going to buy it? You just go around and who are the people that are actually buying the phones? And then you have your Samsung thing. I talked about that. I mean, even if the next competitor gets, Samsung will be back. If the people who bought the Samsung, I don't think they're going to run out and buy the Apple. That's how I look at it. And remember that there's multi-tier pricing. Pricing is different in Asia than it would be in America or Europe. We're seeing prices come down and things of that nature too. But I do expect, cell services to be clubbed next. Once everybody puts everything in perspective of value of what they get out of it, I expect cell services to come down. So in my case here, I wouldn't play this as much for Apple. That's just me. It's not as, like the earnings that were, I think we're down here, 92 or something. And the earnings came out and it opened up at 103. I think this was it here. 90, 97, 98, and then open up at 103 earnings. That one was an easy peg. But for right now, I'd rather find an area to short Apple. I can't see any continuation higher. Here's ExxonMobil. Once it peaked back, tried again, failed, make the lower low. We're getting some sort of sideways pattern. Today I noticed that the Canadian dollar is kind of holding in there. Oil hasn't really fallen through yet. I think basically if it loses 50, it'll probably go to 48. But with the Canadian dollar where it's at, I think oil is still kind of stuck in its range. Exxon is basically, I kind of just look at this as a sideways pattern before going lower for right now. But, oil hasn't moved lower yet. So outside of an earthquake that busts a pipeline, that kind of thing, I'm defensive on oil in that just due to the fact that commodities will be under pressure when the dollar continues higher. Intel, the chips were pretty strong, did roll over. They're not the growth industry that they used to be, margins, things of that nature. And when the chips are more powerful, you need fewer chips, that kind of thing. I think I mentioned SOX, SOXS, as one to watch. I think that's a 3-timer. What was the other one? TECS was another one to watch. and that's just due to the fact that usually what happens, the strongest sectors become the weakest. So like we saw the utilities continue to pull in money when people were chasing after yields. It rolls over and becomes the weakest. So whatever strong sectors that are out there, chips, telecom, I think then they become the weakest is how it goes. Well, that's what it is. If everybody's looking over one side of the boat, which is how it works in a bull market, right? You still have what we'll say 90% long and 10% short, and at some point it stops. Walmart will probably go the way of Sears. They all do. Equities are designed to maximize, the corporations, the firms maximize profits. they expand. Sears started as a catalog, like we'll say Amazon is a catalog. Okay. Then they got into the stores, they got into brokerage firms and credit cards and yada, yada, yada. And now Sears is basically holding on for its life. Walmart, the same thing. Massive buildings, lots of air conditioning, a lot of expenses. And you have the competition too. I mean, I'm sure there are people in certain areas that use Amazon instead of Walmart for their daily goods. Delivery, we're doing deliveries, daily deliveries. There's a lot of change, but a lot of stays the same. So I think Walmart, just in general, they will benefit from a stronger dollar, though, because they'll have that'll help with the imports. But basically, how I see this here is, Walmart peaked, and it's a hurting kind. Here's Verizon Communications. Boom. How can the stock market continue higher when you have this going on? You have a lower low here. It is pausing on Fibonacci level. But, you have double hooks here and MACDs. Like I said, if the bulls want to run this thing higher to, what do we say, 2,200 or so, and then I think the next level, this is for ES, 2,200, then 2,350. It's going to have to be broad-based here, More than likely, whatever does move is going to be in your NASDAQ. That's the cycle that we're in. Basically, technology and growth. The smokestacks will have difficulty with the stronger dollar. 95% of the world is over there. I think, what was it? Coca-Cola, 80% of profits overseas. McDonald's, 74% overseas. So you have, that's the strong dollar is going to cause havoc on your repatriation of the dollars on the balance sheet. But what happens is commodity prices come down in that. We're in a home building phase and an auto replacement cycle. And so it shifts. And plus also we've just spent, 7 years buying back stock. So there's less stock, and it's just how it goes. We just rotate how this all plays out. So Disney, the same thing, and here a couple of double tops. It walked. I think it actually peaked before. Where was it? It was here. So here was the whole talk about Star Wars, and it peaked prior to it. And here we are down here, and, they make a lot of profit comes from ESPN. You could have a football strike here in the next couple of years. I mean, it's just, there's a lot of things that a lot of these companies are tied to. In China, they're not going to the parks. What was I? I went to like Six Flags website, and I think it was Six Flags, and they offered 6-month payment plan to get a ticket, and I just went, you got to be kidding me here. So here you have, and that's a lot of, what do they call it? Drop cost, dead weight. And to put the park together, it's a lot of investment in the rides. And then, people are going to weigh the price of the ticket and standing in line, even as efficient as doing armbands and stuff. You take the kids once or twice. But it's tough sledding. It's all the same thing, hit or miss with movies, TV. I mean, like I said before, if you pay your employees, we'll say fair, they'll buy more widget. It helps out everybody. When you tie your pay to the stock price, that doesn't help anybody, especially when you run out, sell debt, and you're not investing in production, okay? And in investment, you're buying back stock. It only helps out a certain segment, the half the people that own the stock, and not the people working for it. It's all tied together. It's all tight, and especially now, I guess wages peaked back in 2000. So whatever the price was a ticket in Disney in 2000, uh, there you go. Okay. Here's another one. Pfizer, boom, came out the top, came back down. So you hear about we're within all-time highs. Pfizer's basically pausing down here. These are pretty hefty pullbacks. Same thing. I mean, just as you can see, it's tough for the market to move higher. Okay, now banks. Okay, as we raise, as interest rates go higher, banks are more. They'd lend more, right? Because the margins are wider. Okay, so here you want to during this cycle you want to own banks and other financials, and then you want to get into the home building. The only caveat here we have with home building is that we have so many homes from the baby boomers. So we have to look at it as when the boomers pass, and what happens with the home. Do the children end up living in the home? Do the children end up selling the home? So we're going to kind of be faced with a little bit of that. Kind of look at it as the growth we saw in we'll say the 70s and 80s and that with homes, the home growth, the larger homes, you had the boomers in their most productive years. We'll face the tail end of that with every force equal and opposite force, blah, blah, blah. But even though I favor the banks, it's basically buying on weakness because we're not at the end of the real estate cycle yet. That's in 2024, so we still have time. But the banks seem to be doing other than, when they come back and say that, their earnings were great because of their bond trading. Well, once again, how does that help out Main Street? At some point, you're going to be flipping it to yourself, right? Okay, here we go. DuPont, same thing. This is having a tough time busting through here. Once again, we have a peak back in 15. Yeah, basically to 15, another peak. I view this as just a lot of short covering here. DuPont and that, they're going to have problems with the stronger dollar with exports and that. But I think, the whole merger thing comes back. So it's one of these that it's, even though you have a decent plan in here, you can't, the ignorance of some companies. Some of us remember the Time Warner AOL deal, so in 2000, how that worked out. And what was the other one? MySpace, whatever. It's, it's one of these things that, I prefer just to watch a few markets, say like the S&P futures. We'll just say S&P futures, the dollar for Forex, and debt, because when you're talking zero interest rates and negative interest rates, they can only go up, right? So, like I said before, it's not that I'm bearish on stocks. I'd like to see a healthy, short, quick pullback, but I don't find stocks expensive. They are some of them are pretty well up there. I'm kind of shocked, but the better opportunity. It's kind of like for buying stock equities in 2008, 2009. I look at it as the same time with debt, for shorting debt. You're getting that opportunity, and so the one thing I hate is I'll get emails and stuff, and they'll chase after the du jour. You already have to be in it. I mean, if it's moving one way, you don't think, just click and cross your fingers. But the deal is I prefer to have somewhat of a plan, because you end up chasing after these things and it drives you crazy. And then the worst thing is then you go look for news. Well, if something moves, up 25%, we'll say Netflix up 25% in a day, everything's going to be rosy. And in Netflix, it's the same way. They have to get the content. Well, this merger comes through. Guess who's not going to share their content? I'm going to guess AT&T, right? I mean, I heard, what did I hear? Oh, if you watch Time Warner programming, it won't affect your data usage. So there's sly ways of, forcing people. The deal here is that advertising, what was it? It's over $500 billion a year. So it's just as large as U.S. spending on defense. That's where communism is in this country, Defense Department. But getting people off the couch and buying stuff is huge. So advertising is a huge deal. So, and you have to have eyeballs. And things like Netflix, no commercials, Hulu, you have commercials, that kind of thing. That's how they make their money. And, that's how they weigh it with their content. If they now a lot of these like TNT and all these, they're all trying to do their own channel thing. That's not going to work either. We're lucky these days that we're able to watch when we can watch it on demand. I mean, I remember my father having 3 VCRs because they'd all show the frickin', everything at the same time. So if you wanted to watch whatever, Dallas and, whatever, they're all at 8:00 at night. So you have to record all 3 of them if you're out of town. So luckily for now we have on demand, so I can watch Saturday Night Live 2 weeks later or whatever. If everybody finds it's funny, if I want to invest, an hour in something, but even though it looks good on paper and stuff, you still have to perform. So, but DuPont, I think they were trying to merge. They're all trying to merge to cut costs. It's and fire people, which of course sets up the recession, right? You have all these people who are chemists, professionals, and then they get the chopping block. Goldman Sachs. Now this one, I thought the possibility here that there's going to be a stall and then it continues lower. And you think Goldman Sachs, you think they're on the inside of stuff, but they have their own problems too. It's tough to do IPOs when the stock market's falling, cratering, that kind of thing. I think we had a lot of mergers and M&A activities, but not a lot of IPOs this year. So, here it is where there's a Fibonacci line and Goldman Sachs is pressed up against it. So, once again, here we have something that peaked back then. We're basically getting a bounce. I look at a lot of these that are swinging this way, like Apple and Goldman Sachs. And these are just kind of bear market rallies. I mean, we don't have to say it's a bear market, but just the pattern itself. It's lost here. Now we're trying to press up against it. If like I said, if the earnings this week on these big name things can't pull this market up, I have to believe that you're now going to get the people who thought, say, Tuesday was going to be up day for, like, say, Apple earnings or what have you. That doesn't work. They're going to sell, because like I said, with the merger on Sunday night, I was shocked myself it didn't open up higher. I thought it would open up like 6 to 8. And then basically it went flat on it. So that, to me, the first thing I read was, I said, okay, if the setup was that which the market should go higher, and it did. When it finally got to Europe, it finally opened up, and we went into the 40s for the E-mini S&P. So that the plan worked out, and here it is, opening up at the high, and then they pull it back. But if the people that jumped on it, they see the Netflix earnings, they see whatever earnings they want to see, selective cognitive dissonance. So they only look at the things that went up, and so they assume that Netflix is up and Time Warner's up, that Apple should be up too. But then they missed the ones that were clubbed in the background. I think IBM was down 4 or 5 one day. But We shall see. You know, if the Bulls lose this year, I think then we finally roll over for good. Johnson and Johnson, same thing. Johnson and Johnson, it was a healthy mover for a long time through here. Take a look. Here's a 10-year. You know, and now we're coming back, and they sell stuff overseas too. And a lot of them have moved. I mean, we're talking. For 7 years, 7 years into this, you know, into basically the bottoming action. American Express here, to what, 2015, 2014, all the way down. I mean, you know, it would be tough to hold on to this. I think what you call it's in this too. Warren Buffett, he has money. He's, you know, he's reaching the end of his, you know, golden years kind of thing. So this is a pretty good move to, you know, 60 would hold it. I would have to say it'd probably move up into here. That would be the next area. I just, American Express is going to have to, it'll probably have to be sucked into somebody else here. Reminds me of Western Union, you know, that kind of thing. They'll have to rebrand themselves. General Electric, this, if you're an owner of General Electric, you know the pain, how long it's taken. Here's another one that peaked in, you know, this is 2007, and it's, you know, we're making what is that, about 40 to 30, yeah. So you're, you know, 2/3 back. And like I said before, if General Motors can go bust, any of these can go bust. One, you know, one way or another. They have retirement issues for pensions. They have, you know, a lot of these things are big ticket items, you know. And then, of course, think about this one, big ticket items. If we're more efficient, we're going to need less. So the technology, it also hinders here. But, you know, we're below the moving averages. I would expect that this would be some pressure on General Electric. Caterpillar, same thing. Here's the high, rolls down. We're back to, you know, it's going to be tough for a lot of these. We're out of the commodity cyclical or secular commodity bull market. So I'm looking at, you know, this is going to have a tough time, just like in the 80s with the strong dollar selling their goods overseas. Here's Merck, same thing with the drugs. How about this one, right? You know, you still have to consume the pills. What do we have? 47 million people not on with healthcare. So, you know, here's another one, right? If you want your Merck stock to go up, national healthcare. But yet for the life of me, I don't get it. You know, I pay SUDA, I pay it twice for being self-employed. You know, what's a little bit more for insurance or whatever, you know, whatever. Eventually, I guess the British got national health care after the Germans bombed them. So it just makes sense, right? I mean, overall, in general, your labor, you want healthy labor. You know, there's nothing like a company asking for a note from your doctor and you're looking at them going, are you going to pay for that? You know, and it gets worse, of course, because we're not doing the union thing anymore either. So, I mean, they can fire you because you're sick, you know, whatever. But it's one of these things that everything will adjust. I mean, you'll get to a point. I mean, just like it's like the McDonald's workers, you know, going on strike. I had to look at that as a positive thing. I mean, that's all. Hey, look, they're more than willing to work. I mean, you don't want to turn over with your labor, then you have to train them and blah, 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 yada, yada, yada. Just pay them, you know, just like the olden days when things were really good in the 50s, right? You know, a plumber, you know, You could actually have one person stay home, right? And only one person had to go to work. Now they're both going to work. Nobody's watching the kids, you know. So, but eventually it'll all correct one way or another. I know how. A world war. Exactly what we need right now. All right. So Merck here, you know, you have the thing with the top and the pullback. And, you know, there are people that pop the pills are going to be your boomers, right? And every day, what is it, 10,000 people go on Social Security, but there's a birth death index too. So it's, you know, the youngsters are the ones that don't have the insurance, and the older ones do. It's like seeing a doctor, but you know, you know, it's, what do they call that? Salting the mine. When you put like gold or silver in the mine to make the numbers. Same thing here. Convince everybody that they want national health care. Get them on it. Well, however you want to work it. Don't make a missile system. Get everybody, and it'll help everybody else out. It just works, right? You know, whatever. I'm not running this year. I'll vote for myself again this year. There's Procter & Gamble. I remember back in the 80s, there was a mutual fund that unloaded Procter & Gamble, and the stock actually dropped $25 in one day. I'd be shocked if the playbook happened again. But Procter & Gamble is a big-time company. You know, once again, they peaked back here in 2014, came down. You know, they spent basically 2 years trying to do a retest, and this doesn't look good here. And they have, wow, could Coca-Cola and Procter & Gamble merge? I don't even want to think about this stuff here, because you're good, you know, when you have hundreds of thousands of employees, you know, but they're going to have problems overseas, right? 95% of the world's overseas. Stronger dollar, it's going to be tough sledding. Chevron, another one is sideways here. To me, oil is dead money. We're stuck. You know, we're done with the commodity cycle. We're basically in a technology swing. You're, like I said, your NASDAQ and Russell and NASDAQ, Russell, and your growth stocks. That's where we're at right now in the cycle. United Healthcare, thought I had one here, and gave me this, so we'll see about that. United Health, same thing. You know, you have, you know, your boomers. It's like the demand for nursing right now. 15, 20 years, the nurses are going to be coming back trying to do something else. McDonald's, I don't know the reasoning behind this one here, but it's had a pretty good move from, I remember when it was $9 in the 90s. So it's had a pretty good move here. And that's the thing. You run out of places to put the money, even though it doesn't make sense. You know, if you're looking at it like earnings or your PE, like with Amazon, if it's doing this, you're going to put the money into it. Now it's doing this. That's a hell of a reversal here. So I'm going to say that McDonald's is going to be under some pressure here for a while. I guess McDonald's and Coke could merge. That's it. I guess that's that. So I'll post this up and let's take a look here. ES. So we had a high of 49, which is, we said 50-52 would be I guess 48 to 52 would be the first stopping point. YM. The NASDAQ though, and the Russell's faltering. So it's 8:20 in the morning here, and market's been open for about 2 hours, and we're basically stuck. Not as frothy as I thought, but we'll see about a swing here into lunch. Everyone take care. Bye-bye.